right now I'm just gonna share like a pretty a pretty simple method. It's like using like some basic metrics. Um, like for example, Sharpe ratios and stuff. So like using some pretty basic metrics, but these are really good metrics, and it's a really good like it's a really good method to like select a portfolio or some stocks. So number one, get your monthly returns over at least 5 years. Oh, like, this is for a portfolio. So like if I like am choosing between mutual funds, I would like get the monthly return of a mutual fund over at least 5 years. So more than 10 years would be better, but some mutual funds don't last that long. Step number two, calculate the following metrics. So there are many, but the following are the most important ones for like calculating like the returns of a portfolio or yeah, of a stock. So here's a compound annualized growth rate, growth return, standard deviation, maximum drawdown, and Sharpe ratio. So the compound annualized growth rate or growth return, sorry, it's calculated by this formula. So I'm not exactly going to elaborate that much on like the mathematical proof behind this formula. Um, so there's basically the ending value divided by the beginning value, um, and or like the ending value and beginning value, and that's to the power of 1 over the number of years minus 1. So given a portfolio, in year one, the return is 20%. In year two, the return is negative 15%, and in year three, the return is 10%. So what do you think its CAGR would be over the 3 years? Um, if you don't want to calculate this mathematically, as I guess it would be kind of lengthy to calculate it mathematically, fine, what would you guess its CAGR be over the 3 years? Like the compound annualized growth return.
Wait, what's the initial investment for the example?
And CAGR in percentages then. You can calculate in ah. You don't have to know the begin like the number of money to calculate the beginning value and ending value. If you really want to just say it's 100. Okay, it's if you're saying it's 100 and you can get it out in calculators, if the beginning value is $100, then what would you predict the CAGR is over the 3 years? Okay, then, and you know you can just like say your estimated one. Um, okay, so the ending value over beginning value is basically 1.122. So this is like a decimal. So using the above formula, we can calculate that the CAGR over the 3 years for a given portfolio is approximately 3.91%. So on average, it earns about 4% every year. Next is the standard deviation. This is to measure the dispersion of returns around the mean, and is often used as a measure of risk. A higher standard deviation implies greater the dispersion of data points around the mean, blah blah blah. Basically, like it's just like measuring like the risk and like the variations of a portfolio. And obviously, the smaller the standard deviation, the better the portfolio is. So here is another formula for the standard deviation. And no, I will not ask you to calculate this right now. There's also drawdown and maximum drawdown. A drawdown refers to the decline in the value of a single investment or an investment portfolio from a relative peak to a relative low. So you can see from this high point to this lowest point, that's a 20% drawdown. Basically, it's the percent difference between the previous high point on your equity curve and the lowest point on your equity curve. And again, the smaller the max drawdown, the better a portfolio is. Because of course you wouldn't want it to go that very have very high losses, right? Or have very low loss, have a lot of losses. There's also Sharpe ratio. Sharpe ratio is a measure of risk-adjusted performance of the portfolio. It is calculated by dividing the mean monthly excess return of the portfolio minus the risk-free rate by the standard deviation of the excess returns. And the displayed value is annualized. The higher the Sharpe ratio, the better our portfolio is. So here's the formula for the Sharpe ratio. It's the return of a portfolio minus the risk-free rate over the standard deviation of the portfolio's excess return. And the annualized Sharpe ratio is basically calculated like this. Again, you don't have to calculate this, but just like to compare it, usually any annualized Sharpe ratio that is greater than 1 is considered acceptable to good. And the higher the Sharpe ratio, the better it is. An annualized ratio that is greater than 2 is rated as very good. And an annualized ratio greater than 3 is considered like excellent, like super, super, super good. But active management, for example, like in a mutual fund or something, can achieve this, but index funds can't achieve this. Index funds are like the 1 to 2 range, I think, like 1.5, I think. An annualized return that is an annualized return that is less than 1 isn't very good usually. So here's a calculation example, assuming the risk-free annual return is 4.5%. This is a whole operation fund, SPY and QQQ. So step 1, you convert the annual risk-free rate to a monthly rate. You calculate the average monthly return of the portfolio. You calculate the excess return. You recalculate the standard deviation of the portfolio's monthly returns. You recalculate the monthly Sharpe ratio. You recalculate the annualized Sharpe ratio, a lot of calculating. And then you get the whole operation fund Sharpe ratio. So this is 2.45%. Over here you can see an annualized ratio that's greater than 2 is rated as really good. So this is like a very good Sharpe ratio. As I said before, SPY and QQQ, since they're index funds, they don't have a very high Sharpe ratio. It's still good, 1.3 and 1.28, but it's like usually index funds can't reach to like above 3 or a lot of above 2. So now let's compare the S&P 500 index fund and the 3 famous portfolios. Bogleheads, 3 funds, David Swenson, Yale Endowment, Ray Dalio, All Seasons, and Vanguard 500. Oh, that's the index. So commonly a portfolio is good at some metrics, but bad at other metrics. So different investors will prefer different trade-offs among these metrics, because usually portfolios, they have like this good attribute, and then sometimes they have not so good, and usually like portfolios, they're good at some metrics, bad at other metrics. It depends on what your own personal preference is. So what portfolio would you prefer and why?